As pressure mounts to introduce a wealth tax in the UK, innovative tax strategies could pave the way for increased revenues. In this blog post, I'll examine options such as capital gains tax reforms, inheritance tax simplifications, and broader taxation measures targeting wealth, while steering clear of a flat wealth tax for all. In recent months, discussions surrounding a potential wealth tax have gained significant traction. As the government feels mounting pressure to explore new tax avenues, alternative strategies can offer viable solutions without resorting to the implementation of a wealth tax. The conversation has turned towards realistic options for increasing tax receipts that would not overburden individuals financially engaged with extensive assets. One of the main considerations at the forefront of this discussion involves capital gains tax. Many tax advisors advocate reassessing the CGT structure, primarily the rebasing system following an individual's death. Under the current rules, when an heir inherits an asset, the market value is reset as of the date of the individual's passing, alleviating the burden of previously accrued gains. This approach effectively erases the tax obligations on capital gains for the estate's beneficiaries, leaving the system prone to loopholes and inefficiencies. The prospect of abolishing this rebasing could be perceived as a simplification, but it bears consequences that could adversely affect families inheriting property or capital assets. Without the upward adjustment at death, heirs would take on the original value, meaning significant tax liabilities could be incurred on the full appreciation of the asset when it is eventually sold. For instance, imagine inheriting a property valued at £300,000 that the deceased purchased for £100,000. Should the rebasing be removed, upon sale, the heir would be liable for CGT on the entire £200,000 capital gain. This removal of the CGT uplift could create scrutiny amid families who find themselves grappling with dual tax burdens: inheritance tax, IHT, and CGT. Another avenue worth considering is the potential reforms regarding inheritance tax and the residence nil rate band, RNRB. Introduced in 2017, the RNRB allows individuals to bequeath a primary residence to direct descendants, exempting up to an additional £175,000 from IHT in addition to the standard rate. While the intention is to ease generational wealth transfer, the reality is that this addition complicates the existing framework of IHT, making compliance and understanding a challenge for many. A reduction or complete revision of the RNRB could simplify the tax system and potentially increase revenue receipts. However, there is an inherent risk in altering the already frozen nil rate band of £325,000 since 2009, as this could risk backlash from an electorate that has long awaited adjustments to the thresholds and regulations governing their tax responsibilities. Beyond CGT and IHT, exploring changes to dividend taxation and local property taxes could present further opportunities for revenue enhancement. The current council tax system may find itself under scrutiny given its reliance on outdated property valuations. A new model could secure fairer contributions from property owners while ensuring that local councils receive the necessary resources for public services. Additionally, the recent discussions surrounding the potential rise in CGT rates highlight inherent contradictions. Increased rates are often presumed to yield higher tax receipts. However, the reality, as noted in HMRC modeling, suggests the opposite could occur. In fact, increasing rates could dissuade investment behaviors and in turn lead to decreased revenues. Given this backdrop, the notion of a wealth tax may carry with it more pitfalls than potential benefits. By broadening the approach to taxing wealth rather than relying on a singular wealth tax, the government can tap into existing frameworks that can be revitalized for contemporary challenges. Devising a strategy that targets existing tax streams can yield better results than relying on the contentious introduction of a wealth tax, which could deter high net worth individuals from engaging economically in the country. As the debate around taxation in the UK heats up, exploring alternatives to a wealth tax should remain a priority. Strategies around CGT, IHT, residence nil rate band revisions, and broader property tax reforms can lead to a more equitable, efficient, and well-structured tax system capable of addressing today's economic demands. By strategically navigating these discussions and considering nuanced modifications to existing tax frameworks, the Chancellor may uncover pathways that foster economic growth while ensuring fiscal responsibilities are met. The impending budget should spotlight these alternatives. If anything I've written in my blog post resonates with you and you'd like to discover more of my thoughts about a wealth tax, IHT, CGT, and how I'd tweak the existing tax framework to increase revenues, then do feel free to call me on 07434 287603 and let's see how I can help you.